Welcome to Crypto Insider USA, the only place where crypto news doesn't just hit, it explodes with energy, insight, and just the right amount of chaos to match the crypto market itself. If you woke up this morning feeling like your portfolio had a hangover despite Bitcoin barely losing a step, you're not alone. Today's headline is shocking investors worldwide as strategy. The Michael Saylor-led titan of Bitcoin Treasury plays slumps over 6% even while Bitcoin itself drops just a hair above 2%, leading to a widespread red sea across other crypto-related stocks, and pushing many to question whether leveraging balance sheets to accumulate Bitcoin is the dream it once seemed, or a ticking time bomb about to detonate across the financial markets. And folks, if you think today's minor correction in BTC was scary, wait until we zoom out and realize that MSTR shares are down over 30% from their 2024 peak, even as Bitcoin touched an all-time high this week of nearly 109Ks. Yes, you heard that right. It's not the crypto coin that's bleeding. It's the companies holding the coins, and the broader community is starting to ask a deeply uncomfortable question. Has the Saylor-style Bitcoin vacuum corporate strategy become the new Trojan horse of financial fragility in the digital age? Or are we just overreacting to a temporary hiccup in market momentum? The conversation is on fire right now, with everyone from Low Strife, the Bitcoin poster stirring up controversy on crypto Twitter, to legends like Nick Carter and Adam Back chiming in on whether these Bitcoin treasury companies are building sustainable futures or just dangerously inflated balloon animals ready to pop with one wrong interest rate spike. And if that wasn't enough, Japanese-listed Metaplanet decided to steal the spotlight by crashing an eye-watering 24% in a single session, leading many to question whether Asian markets are more sensitive to these strategies or just more honest in their panic, because let's face it, the crypto world can hide a lot of sins behind a bullish candle. But when the tide turns, everyone's swimming trunks, or lack thereof, become embarrassingly visible. Now here's where it gets even more interesting. A growing group of skeptics are pointing fingers at the financial engineering behind all this, calling the mNAV metric, that's market cap to net asset value, the real villain of the story. Because as long as that magic number stays above 1.0, these firms can keep playing the game, raise money, buy more Bitcoin, pump the share price, attract more capital, rinse, repeat. But when mNAV slips below that critical threshold, the party doesn't just stop. It turns into a margin call-driven, capital freeze, investor exodus type of nightmare that might make the GBTC discount days look like a picnic in comparison. And, speaking of GBTC, remember how it once traded at a massive premium during the 2020-21 bull run, only to nosedive into a discount so severe it kicked off a cascade that wrecked Three Arrows Capital, damaged Genesis, and, oh yeah, helped light the fuse that blew up FTX? Well, analysts are saying we could be walking into a similar trap. Only this time it's not a trust product under scrutiny. It's entire public companies leveraged to the gills in Bitcoin. And if they start puking their holdings to maintain solvency or service debt, it could create a wave of selling pressure that even the strongest BTC bulls might struggle to absorb. So naturally, the question everyone's asking is whether we're seeing a healthy market correction, or the first shiver before the full-blown flu hits the Bitcoin ecosystem. And funny enough, let's just pause here to ask, if Michael Saylor is the Bitcoin, Jesus, does that make mNAV the devil's calculator? I mean, seriously, who knew corporate treasuries could cause more panic than an SEC lawsuit? Anyway, let's break it down further. The reason why strategy and similar companies are more vulnerable than Bitcoin itself is because stock valuations are tied not only to BTC's performance, but also to investor sentiment, debt covenants, and the broader macroeconomic environment. So when BTC dips even slightly, these companies get punished disproportionately as investors reassess the risk-reward profile of holding equity in a firm that's more like a Bitcoin ETF with a PR department than a traditional business. And the debate is getting louder with each tick down in the chart. On one side, you've got the MSTR bulls like Adam Back arguing that even if mNAV dips, companies can simply sell BTC to buy back shares and boost BTC per share metrics, making it a net win for shareholders. But critics say that's just window dressing on a fundamentally unsustainable model that relies on eternal BTC appreciation and infinite appetite from retail and institutional investors alike. which, let's be honest, isn't exactly a safe bet in a world where inflation, regulation, and geopolitical instability are threatening every major financial narrative. And while Bitcoin itself might still be strong, the vehicles investors use to access it are increasingly under pressure, from closed-end funds to public equities to ETFs. And it's becoming clear that not all roads to Bitcoin are created equal. Some might be smoothly paved highways, others winding mountain trails, littered with bear traps and margin calls. And let's not forget the psychological impact here. When retail investors see Bitcoin barely moving but MSTR tanking, they start to question the wisdom of indirect exposure altogether, potentially dragging down demand for these securities and creating a feedback loop of falling prices, lower mNAV, fewer capital raises, and more BTC liquidations. A loop which, if left unchecked, could end in serious damage not just to these companies, but to market confidence in Bitcoin as a whole, especially for newcomers who might not understand the difference between BTC and BTC-backed corporate stock. And that's the crux of the crisis today: perception versus reality, leverage versus liquidity, faith versus fundamentals. And while Bitcoin maximalists might cheer every dip as a buying opportunity, the real question is whether they're ready to stomach the pain if this mNAV domino effect spreads through the crypto equity world like wildfire. Because at the end of the day, Bitcoin might be decentralized, but the methods we use to accumulate and access it often aren't. And therein lies the risk. So folks, stay alert, stay informed, and if you're investing in Bitcoin through companies instead of directly, make sure you understand not just the coin's price action but also the corporate balance sheet, the debt terms, and yes, that sneaky little mNAV number that could decide whether your investment is safe or skating on very thin ice. And with that deep dive into today's biggest crypto shakeup, don't forget to smash that like button. If you found this insight valuable, hit subscribe for non-stop updates on everything happening in the wild world of crypto, and turn on notifications so you never miss a beat. And of course, drop a comment below. Are Bitcoin Treasury companies the future of crypto finance or a disaster waiting to happen? We want to hear your take, and trust me, we read every comment, every theory, every meme, because this is your community, and together we'll ride the highs, survive the lows, and laugh our way through the chaos of it all. And as always, we'll meet again, next news, same channel, same time.